The moving average convergence divergence, MACD, zero-line cross strategy is one of the most popular and straightforward trend-following techniques used by traders to identify momentum shifts and potential entry or exit points in the market. The MACD indicator itself is built from the difference between two exponential moving averages, typically the 12-period and 26-period EMAs, and is plotted as a line that oscillates above and below a central zero line, accompanied by a signal line, usually a 9-period EMA of the MACD. The core idea behind the zero-line cross strategy is simple yet powerful. When the MACD line crosses above the zero line, it indicates that the short-term moving average has moved above the long-term moving average, signaling that bullish momentum is strengthening and an uptrend might be forming. Conversely, when the MACD line crosses below the zero line, it suggests bearish momentum as the short-term average falls below the long-term one, indicating the potential start of a downtrend. Traders use these crossovers as confirmation points to align their trades with the prevailing market direction. The beauty of the zero-line cross strategy lies in its ability to filter out smaller, short-lived price fluctuations and focus on significant changes in trend direction. Many traders prefer to wait for both the MACD line and histogram to confirm the crossover, ensuring that the shift in momentum is supported by increasing strength. However, while the MACD zero-line cross can be a strong trend indicator, it performs best in trending markets and can produce false signals during sideways or choppy conditions. To minimize false entries, traders often combine the MACD with other technical tools such as support and resistance levels, volume indicators, or trend lines. For example, if the MACD crosses above the zero line while the price also breaks a key resistance level, the probability of a sustained bullish move increases. Similarly, when the MACD drops below zero alongside a breakdown of support, it strengthens the bearish bias. Some traders also refine the strategy by observing price behavior on multiple timeframes, using higher timeframes like the 4-hour or daily chart to confirm the overall trend while executing trades on shorter intervals. The zero-line cross is particularly useful for swing traders and position traders who prefer capturing medium to long-term price moves rather than short intraday fluctuations. Discipline and patience are essential, as entering too early before confirmation or ignoring the overall market context can lead to losses. In essence, the MACD zero-line cross strategy is not just a mechanical signal. It reflects a transition in market psychology, where the balance between buyers and sellers shifts decisively. By combining it with sound risk management and proper confirmation methods, traders can use this strategy to ride strong market trends with greater confidence and clarity, making it a valuable tool in any technical trader's toolkit.